Ladies and gentlemen, good afternoon and thank you for joining. It's a pleasure to see you all today. The plan is for our team to talk for about 25 minutes on the performance of the World Stars and our views on the outlook, followed by Q&A. Thank you for the excellent questions already submitted, and do send more if you wish. Could I please ask you to note the disclaimer? As before, the presentation will be led by Jerome and Chris. They're joined by Katerina, the Deputy PM of our World Stars Global Equity Strategy and Head of ESG. She's been with the firm since 2013 and today will present a section on ESG, detailing our research approach, the profile of the World Stars companies, and a short case study on Seeker. Over the last 2 years, we've fully integrated ESG research into our investment process, and our analysts write dedicated ESG reports on every company on the approved list or held in the World Stars. We've also included our views on inflation and the ability of our stocks to withstand inflationary pressures. Now it gives me pleasure to introduce Jerome Stan.
Thank you, Sandy. Good afternoon to everyone who has joined us. Thank you for taking the time. We are very pleased of the development of our World Star strategy and the performance it has delivered. Our business continues to grow with AUM now around $1.2 billion, supported by strong performance and inflows. About 25% of our assets are owned by my family and the partners, and the balance by other families, charities, trustees, wealth managers, and institutions. Our World Star strategy is now close to 9 years old and delivers results well ahead of our target return of 8 to 10% or more per annum. It invests in a concentrated group of 20 to 30 high quality, sustainable, global large caps and mega caps with enduring competitive advantage and a long runway of growth, selected through our intensive in-house fundamental research. Quality is the defining condition for a stock to be selected, followed by value. The strategy has been managed by the same team since 2014 and is available to clients through separate managed accounts or through our UCITS fund. Investors can invest alongside my family in a strategy that has successfully generated strong returns for over more than 60 years. I'm pleased to report on continued strong performance by World Stars Fund in absolute terms and consistently ahead of the MSCI World Index. This year, the fund is up 16.7% in US dollars and has outperformed the index, which we also achieved in 2020, over the last 3 and over the last 5 years, as well as since inception in 2012. For example, over the past 5 years, we have outperformed the index by 18%. From mid-November last year and through the first quarter of this year, there was a marked rotation to value and towards sectors which had fallen most sharply during the pandemic. But since April, this has more than reversed with a sharp swing back towards quality and growth. The World Stars has fully participated in this rally and outperformed the MSCI World by over 4% in US dollars to the end of August. The refocus on quality and growth in April was partly driven by valuation, but also partly triggered by the powerful rebound in revenues and profits reported by many high-quality companies. For most of our World Stars companies, their revenues are now well ahead of the pre-pandemic level of 2019. We remain optimistic about the substantial global recovery over the next 2 to 3 years, and confident in the ability of our focused portfolio to continue to deliver significant value over time. In the shorter term, we see the global economy going through a phase of transition as it progressively normalizes. The increased associated uncertainty will invariably lead to volatility, but our strong message is to remain patient and to invest only in the highest quality companies. I will now hand over to Chris.
Thank you, Jerome, and thank you for everybody for joining us. I want to, for those joining for the first time and as a reminder for the rest of us, I just want to briefly touch on the 4 key criteria that we use to assign quality to the stocks that we own. As we've said, for us, we invest in quality and value for the long term, and quality for us is a gating condition. So a stock can be as cheap as it wants. If it doesn't have quality, we won't invest. We have these 4 criteria: a strong and sustainable competitive position, always also in the sense of ESG, as we've talked about, and as Katarina will go into more detail later on in the presentation. A good and growing industry, a management with a record of value creation, and the financial strength to weather any kind of adversity, a criteria that we think has been particularly important in terms of our companies being able to get through the COVID-19 pandemic, stronger, being able to weather the adversity, to reinvest in the business in some cases, to buy their competitors, and to come out of them stronger than they were. And we think it's also a key criteria and aggregate of why these companies will be able to also withstand the inflationary pressures that we see for the global economy going forward. If we shift to the actual portfolio composition of the WorldStar's portfolio, you can see that it continues to be highly diversified in terms of the sectors that it's exposed to, while it still maintains the allocation to the areas that we think and the drivers that we think are instrumental in terms of delivering the kind of value and growth that we're looking for. You can see it's entirely still listed in the US and in Europe, so we continue to have a high threshold for the incremental risk that comes from investing in other markets where the alignment of interests, the liquidity and other practices may not be as familiar to us as elsewhere. I think that's a question in particular with regard to China, which we have no exposure to directly in the portfolio. But at the same time, you can see in terms of the geographies that the companies that we invest in do business in, it is entirely global, with about half the US, 20% in Europe, and the rest in the rest of world, much of that in Asia, including the rest of world component, which we add up ourselves. So plenty of exposure to the economies where growth takes place, but very conservative in terms of the actual companies that we invest in and where they're listed. It also highlights from a business perspective our continued focus on the areas of where we invest and where we don't. And we continue to be skeptical about balance sheet driven financials, about capital intensive businesses, and about businesses that have exposure to governments. I think we're seeing that in this very difficult transition environment in which we're in, because we continue to believe that we're in a world where it's about OPEX, not CAPEX, where it's about intellectual capital, not physical capital, and where therefore it's about the cash flows that companies generate and not about some kind of a return on a fixed or a tangible or intangible capital base that a company has accumulated or realized through some kind of a transaction. So these convictions have stood us in good stead, and I think they are what make us optimistic also going forward. If we then switch to what has happened more recently and the drivers of the strong performance that the portfolio has had over this year, I want to highlight the most recent growth numbers in revenues that we've had. We think we're at a turning point in terms of the global economy and the pandemic, and where we are going from an environment where there's been great constraints to strong recovery. And you can see that here in terms of some of the exceptional growth rates that the companies that we invest in have delivered. We've grouped them by the areas that we're exposed to. You can see in some cases they're in the 20 to 30% range. In some cases, they are much higher. And you can see that that is diversified. So, of course, in digital transformation, digital advertising has accelerated dramatically with the recovery in the economies. You can see it in some of the consumer companies that we're invested in, but also in healthcare and life sciences. We're beginning to see the opening of the healthcare systems. We're, of course, seeing the testing revenues, which are strong, but are causing volatility and that are behind the drivers of the results that these companies have generated. At the same time, what we want to highlight is that it's very much not just about the allocation to these parts of the economy that we think are favorable. So on the right-hand side, what we've laid out is the year-to-date total return of the stocks that we've invested in, and we've compared it to the sector of the MSCI world that's relevant to them. And so the point is that not only are we able to find the right types of areas, but within them, we are finding the right companies based on our fundamental research, our engagement with the managements, and our judgment. And so in digital transformation, we have outperformed the MSCI information technology sector. In consumer products, we've outperformed quite decisively the consumer index. And on the healthcare, we have outperformed as well as we have on the industrials. So I think that's, an important driver, and it shows the growth that the companies have been able to deliver in terms of the results, but also the diversification, again, of the different type of drivers that allow them to perform. If we then move on to the slide that we have where we want to discuss what we mean by quality and how that compares to the way the traditional growth versus value distinction that people use in asset management, we think that it combines the best of what companies can offer. So we do want companies that are able to grow over time, but we're very conscious of the value that they represent and of the need to buy them at prices that we think allow us to generate our return targets and that are not excessive in terms of the outlook that the companies have on a fundamental basis. So what you can see here is the scatter plot of where the companies in the WorldStar's portfolio are. The blue dot represents the average of where they are in terms of the growth that we're expecting for next year, and the price to earnings multiple that they're trading at. And as you can see, we think they're very balanced. There are some companies that have high growth. There are, of course, also some companies that are trading at higher multiples because of the nature of what they do or because of the strength of their prospects. But there's a very clear cluster that we think represents where the stocks are. And I think it gives you a sense of what we mean by quality and why we think it is a criteria and an area that we think has great prospects, as indeed the results show. If we then turn to the next slide, we've laid out here, again by way of update, the year-to-date performance of the stocks. We've used the same color coding for the areas that we're exposed to. And what you can see here is that there have been the significant contributors to the performance, but again, the highlight is the diversification that the companies represent. The light blue lines are the digital transformation stocks. The top two are Alphabet and Facebook, which, as we've said, have dramatically benefited from the growth in digital advertising, which after all drops through with almost 100% incremental margin. But you can see then you've got industrial stocks that have been significant contributors to the returns that we've been able to generate, and then the pink ones, which are the consumer ones, all of which have been companies that last year did not do as well. And one of those light blue charts on the bottom represents Amazon, which was up 70% last year, the biggest contributor to our performance last year, a clear beneficiary of the pandemic in terms of its business and in terms of its ability to fulfill its own business as well as provide those services for others. This year, it's barely up. And so again, I want to highlight, at risk of repeating myself, that it's the diversification of the portfolio, the different types of companies that we've identified and selected that allow us to perform in different types of environments, and that I think will stand us in good stead. As we said before, we're excited about the companies that we own that are doing well because we think they will continue to perform because of the prospects they have, but we're just as excited, if not more, about the ones that haven't. And what you can see here in particular is that there are a whole number of healthcare and life sciences stocks that have not performed yet because while there have been we're making progress in terms of the pandemic. The hospitals have not reopened. The Delta variant has now filled up capacity again, so that elective surgeries are held back. And we think that some of these companies are ones that are coiled to perform going forward, and that should be great contributors to the portfolio going forward for that reason. If we then turn to another point that we'd like to make, Jerome alluded to in his introduction to the rotation that's taken place in markets. And what you can see here is the actual chart that shows you what took place. The black line is the S&P Growth Index. The light blue line is the S&P Value Index. These are just benchmark components of the S&P that people look at. And you can see that over the last 5 years, the growth index has dramatically outperformed the value index. That's behind this discussion that it's at an all-time high. On the other hand, on the right-hand side, you can see what happened since December of last year, but you can see that in February of this year, the spread opened up very dramatically. At its peak, it was almost 20%. At the time, we said that in the same way, and you can see it on the right, that volatility is an opportunity for long-term investors. We said that this kind of sector rotation is also an opportunity because it simply leaves companies behind. It took place because of optimism about the course of the pandemic and the reopening of economies, which has taken place, even if it clearly is going to be subject to the vicissitudes of the pandemic. But what you can see is that once, from our perspective, once the results of the companies started to come through in March and April, that you saw a significant narrowing of the gap, and it's now completely closed, meaning that that period was a fantastic opportunity to invest in these kinds of businesses as they were being left behind by a market that was chasing stocks that it perceived to be perhaps more exposed, surely more cyclical, but also more vulnerable in many ways because of their characteristics. And I think it's an interesting point to make and one to keep in mind as these kinds of sector rotations and dislocations take place going forward. So with that, I wanted to hand over to Katarina, who's going to give us an overview about ESG and some specific examples about how we're going about implementing and applying it in our investments.
Thank you, Chris, and good afternoon, everyone. As Sandy mentioned in the beginning, sustainability has always been an integral part of our investment philosophy and how we assess quality. But over the last 2 years, we have gone a step further and developed this into a formal ESG framework that is fully integrated into our investment analysis. Our approach is centered on a globally recognized methodology, the Sustainability Accounting Standards Board Materiality Framework, which looks at whether specific factors, including environmental, social capital, or human capital issues, have the potential to materially affect a company's financial performance. We complement this by other factors that we believe to be equally important, which include corporate governance considerations, alignment with global sustainability norms, including the UN's Sustainable Development Goals, and others. Now, there are a couple of things I want to highlight as part of that. First of all, we do the analysis internally. We do so independently. We do not rely on any third-party ratings providers, and we draw our own conclusions. The second point, we focus on the financial impact and the potential risks and opportunities for our companies. We do not use exclusions based on value-based judgments. The outcome of our analysis is a traffic light matrix ranging from dark green all the way to red, summarizing how well ESG risks and opportunities are managed. And you can see on the right-hand side a summary chart with the outcome of the analysis for our WorldStar holdings. Our names, as expected, have well-established practices to deal with sustainability issues, reflected in the predominantly dark green or light green assessment, with no reds. That means no significant gaps in ESG management. On the left-hand side, also interesting to see how our companies align themselves with the UN SDGs in order to meet some of the challenges of our times. Perhaps unsurprisingly, climate change, responsible consumption, equality, and job creation are among the top priorities. Now, climate change is, of course, the biggest challenge for our generation. I want to highlight here we're particularly pleased that our WorldStars strategy has a carbon footprint that is significantly less, in fact, 75% less than the broader market, as you can see on the left-hand chart. This reflects the fact that our holdings are primarily intellectual property or knowledge-based businesses rather than physical asset-based ones. At the same time, our companies have well-established practices in dealing with sustainability. You can see on the right-hand side, 65% of our companies are aligned with the TCFD, that's the Task Force for Climate-Related Financial Disclosures, which means they incorporate climate change consideration at the strategic board level, and 55% have set or are planning to set science-based targets, which means they have a well-established plan to reduce greenhouse gas emissions. Now, of course, the best way to illustrate our work in ESG is through an example. And you see here Sika, a leading manufacturer of specialty chemical products. This is a company we've been engaged to for over a decade, and we own in the WorldStars since March last year. It produces cement additives used in the construction process, waterproofing membranes that are used in roofs or basements of buildings, as well as specialty adhesives used in the production of cars. As with any of the other names, you will see we've got a detailed investment report, which outlines the primary drivers of our investment thesis, as well as a dedicated ESG report that goes into sustainability issues in greater depth. The conclusions of our ESG analysis are summarized in the box in the left-hand side using our traffic light framework that I talked about earlier. As you can see, Sika is doing very well across most dimensions, but we believe it has more work to do on the environmental side. So let us look at that in a bit more detail. Now, as part of its 2023 strategic roadmap, Sika set targets to reduce its carbon footprint. And you can see on the left-hand side that the company has successfully been doing so, reducing the carbon intensity in its own operations. Equally important is that Sika has a significant role to play in helping its customers reduce their own emissions. On the right-hand side, you can see that by using Sika's suite of additives in concrete production, its customers can reduce their own carbon footprint by a third. Now, to put this in context, cement and concrete production accounts for over 5% of global emissions. Therefore, Sika is a key solutions provider, generating ample revenue opportunities, of course, in the process. Now, you might ask me, well, why is it marked as yellow then in the analysis in terms of environmental factors? It is because we believe they can actually do more. The company has yet to set explicit long-term carbon neutrality targets, and it does not disclose Scope 3 emissions, that is, emissions that arise across its value chain. And I want to highlight here, we take these issues seriously. We do not greenwash, and where needed, we engage with the managements of our companies to encourage them to do more. Which brings me to engagement. Now, a key part of our investment approach as long-term investors is having a close dialogue with the managements of our investee companies, engaging them with all sorts of issues, including ESG, that we see are important for the long-term prosperity. During 2020, we held over 65 meetings with the managements of our holdings. In Sika case, we have spoken over the last year with the chairman of the board, the CEO, the CFO, and the head of sustainability. We have pushed them on environmental issues, as I just talked about, but we have also pushed them on human capital issues, especially on diversity, on the diversity of the company's senior management team and its board, where we believe it can improve its metrics versus peers. I think Sika is also a good example of our determination as shareholders to stand up and protect our rights and the rights of our clients. As some of you may know, in the period from 2014 to 2018, the company was subject to a hostile takeover bid by competitor Saint-Gobain, and the bid was structured in a way that would have compromised minority shareholder rights. Throughout this period of 4 years, we worked tirelessly with the company's board and along with other shareholders, including Cascade, the Gates Family Investment Office, to fight the takeover and protect our rights. And we are pleased that we were ultimately successful in that. So I hope that gives you a bit of flavor on our ESG efforts, and I look forward to engaging more in the Q&A session. And with that, I will pass it on back to Chris.
Thank you very much, Katerina. I think it's a very helpful and an important example. I think for us, we're very clear that sustainability is a key aspect and integral to our investment approach. It's in our criteria, and our conviction is that if we're going to generate sustainable returns over time, we have to invest in companies that have sustainable competitive advantage. And in order to have that sustainable competitive advantage, companies have to be acting in a sustainable way towards their own businesses, their customers, their suppliers, and towards their other stakeholders. And I think the important thing is to take a holistic view, as we do, based on fundamentals, to realize that companies like Sika, that after all is involved in the global construction industry, are very much part of the solution in terms of achieving the goals that we have for climate change and for reducing the carbon impact of the economic activity. So thank you for that. I want to then shift to a discussion about some of the other issues that we're seeing and that are concerning us, and I know are issues of concerns for many. I think the key question after this pandemic that we've gone through, the shortest, sharpest shock that we can trace in the global economy, now at a point where we think that we are heading towards overcoming it, where it's clear that the vaccines and the therapeutics and other innovations that we've been able to develop are allowing us to contain it. The next couple of months are going to show whether we're going to, in fact, be able to overcome it, or whether and in what form it's going to be with us. But it's very clear that the disruption and the measures in terms of distancing, in particular, that had to be put in place, have caused a great disruption to the global economy, and in particular to supply chains. So there's a shortage of labor, there's a shortage of goods, and there's disruption and a shortage of logistics and of transportation. So it cannot be a surprise that is going to lead to higher inflation. Prior to the pandemic, it looked like we were worried about the deflation. It then looked like we were going to see some kind of a sustained but moderate inflation that was compatible with the overall growth of the global economy that we were seeing. And we're now facing a period of transition in which the inflation is likely to be very much higher. We're starting to see some of these numbers, but the bottlenecks are going to continue as the demand continues as well, and therefore we're expecting to see spikes in that. However, I think at the same time we've just put some of these points that governments and central banks are going to be extremely supportive in order to support the economic recovery, and in order not to disrupt what is going on, in part because it's the right thing to do, but in part because of also the political uncertainties that we're facing. So we think that companies will have to manage through these issues, but the big companies that were invested in are able to do so, but they will be temporary. And we then, turning to the next page, have put together just an overview of a schematic where we've gone through our portfolio that illustrates why we think the companies that we own are able to weather this kind of inflation. If we are in an inflation environment, you need to have be invested in assets that are able to withstand that because of the pricing power they have, their ability to pass on the inflation that they experience, and their ability to grow because of innovation or other factors, or that have scarcity, clearly in terms of assets that are able to prevail. But what we've laid out here is the fact that the companies we invest in from a qualitative perspective are market leaders. They have differentiated products. They have high barriers to entry. They have different forms. They're operating in good markets where there's good margins, where there's consolidation and price discipline. And we think that, as you can see, regardless of the sector that they're in, we think that they have the ability to raise prices and to pass on the increases. At the same time, if you look at the pressures, we think that they're not as exposed. So because of this focus that we have, that we've talked about, the companies are not as exposed to labor in particular. They're not in general as exposed to raw materials as many. For the digital companies, the exposure is much less material. For companies that produce goods, clearly it is. But in aggregate, we think that they're not exposed then to commodity risk and to the other types of issues that they may face. And again, it ties back to our definition of quality and the companies that we think are able to prevail and will be able to do so going forward. And with that, I just want to then conclude by highlighting then our outlook for where we think we are. We have showed the schematic really just about how we think about what is going on. The gray box has moved further along. I think in aggregate as a framework, it's been right. Clearly, it has moved more slowly than we hoped or also would have expected. But at the same time, some of the major risks that we have in terms of the political unrest and financial instability have been mitigated by the actions that are taking place. Some of the disruptions are with us. We see them as opportunities for the companies that we're investing in. I think on the vaccine side, I think it's essentially where we thought it would be, and we're clearly seeing some of the issues that are coming with that. But the point is that the way we have managed through this is by sticking to our convictions, by doing the fundamental research that we do, by buying the companies, by being sure that we own the right ones, and by holding them. And that has allowed us to take advantage in the previous year to buy some great companies that are more cyclical, that were more impacted. It allowed us earlier this year to buy Salesforce, which is one of the great SaaS companies that we think we bought at a significant discount to where it was trading, in part because of the way its business had been resilient, in part because of this rotation that we were able to take advantage of, and in part because of a market overreaction to an acquisition that they did. So it's by keeping to that long-term view, by having the concentrated portfolio, by having such a low turnover, which is 12% since the inception of the portfolio in 2012, we think that is the way that we have managed through this crisis that we've been going through, and that we intend to do going forward. In aggregate, we're confident about the outlook. Clearly, there will be uncertainty. Clearly, we need to be conscious of the political and global issues that are taking place that we can talk about during the Q&A. But in aggregate, we think that we're facing a recovery, that the inflation we're seeing is going to be transitory, that the companies that we invest in are going to be able to pass on inflation and to prosper, even if it takes hold and moves on. Therefore, we think that the outlook going forward into the end of this year and over the 3, 5, 10, and 25-year period that we're looking to invest in is positive for the companies that we own. So thank you very much. With that, I'll conclude, and I will hand it over to Jerome for the Q&A, and both Katarina and I very much look forward to your questions. Thank you.